Picture this. It's Saturday afternoon. You told yourself you were just gonna look at cars. Just browse, no pressure. But now you're sitting in that finance office and your heart is racing because you actually found the perfect car. The color you wanted, the features you wanted. You can already see yourself pulling up to work in it on Monday. The finance manager, let's call him Mike, slides that paper across the desk with a smile. Great news, we can get you approved at just $512 a month. I know you were hoping for under $500, but that's only $17 more, literally the cost of one lunch. And in your head, $512. I spend that on random stuff anyway. I just spent $200 on DoorDash last month. My phone bill is $150. My gym membership I never use is $80. Netflix, Spotify, that subscription box I forgot to cancel. I can swing $512. This is totally manageable. So you sign, you shake hands, you take that Instagram photo next to your new car, you text your friends, you drive off the lot feeling like you just won, like you're finally moving up in life. But here's what actually happened. You didn't win. Mike won, the dealership won, the bank won, and you just signed away somewhere between $200,000 and $400,000 of your future wealth. I'm going to prove it to you with math so simple and so devastating that you're going to feel it in your chest. And if you're currently making car payments right now, if you have that amount automatically coming out of your account every month, what I'm about to show you is going to make you physically uncomfortable. But stay with me, because understanding this might be the difference between retiring at 55 versus working until you're 70. My name is Rehan, and I spend way too much time thinking about how the average person is getting absolutely demolished by car loans and doesn't even realize it's happening. If you've ever walked into a dealership thinking you're just going to see what they can do on a monthly payment, or if you've told yourself you deserve a nice car because you work hard, make sure to hit that subscribe button and give this video a thumbs up, because what I'm about to show you is going to fundamentally change how you think about car financing forever. Look, I'm not here to tell you that you shouldn't buy a car. I'm not one of those extreme personal finance people who thinks everyone should take the bus and eat ramen forever. Cars are necessary for most people. You need to get to work. You need to take your kids to school. I get it. But here's what most people don't realize. The car loan industry has become one of the most sophisticated wealth extraction machines in modern America, and they've done it by completely rewiring how we think about affordability. When you walk into a dealership, what's the first question they ask? What's monthly payment are you looking for? Not what's your budget, not how much can you afford to spend on a car. They want to know the monthly payment you're comfortable with. And this is where the game begins. This is where they've got you. Because when you think in terms of monthly payments instead of total cost, your brain completely stops doing the real math. It's a psychological trick, and it works incredibly well. Let me give you a concrete example. You walk in planning to spend $25,000 on a car. That's your number. You've thought about it. You've saved $3,000 for a down payment, so you're financing $22,000 at 7% over 5 years. Your monthly payment, $436. That sounds reasonable, right? $436 a month. You can handle that. But then the dealer says, you know what? For just $51 more a month, literally less than 2 cups of coffee a day, we can get you into the upgraded trim level. Better sound system, leather seats, heated steering wheel, the works. You're already spending this much, what's another $50? And in your head, you're thinking, $51? That's nothing. I waste more than that on random stuff every single week. I just spent $45 on lunch yesterday without even thinking about it. So you say yes, and now you're financing $28,000 instead of $22,000. But here's what just happened, and I need you to really hear this. You didn't just add $51 a month. You added $6,000 to the purchase price, which over 5 years means you're actually paying an additional $7,900 when you factor in interest. That less than 2 cups of coffee a day just cost you nearly $8,000. And here's the crazy part. The dealer didn't lie to you. The math is technically correct. It is only $51 more per month. But they've trained you to think in terms of monthly payments because they know that's how they get you to spend way more than you intended. Now you might be thinking, okay, Rehan, but I can afford the payment. What's the big deal? I work hard. I make decent money. Why shouldn't I have a nice car? Here's the big deal. The average car loan term in America is now 68 months, almost 6 years, and dealerships are pushing 72-month and even 84-month loans. That's 7 years of payments on a depreciating asset. Let me put that in perspective. 7 years ago was 2019. Think about where you were in 2019. Think about how much has changed in your life. And now imagine still making payments on a car you bought back then. Dealerships love long terms because it lets them sell you a more expensive car while keeping the monthly payment in your comfort zone. Look at this comparison. Scenario A, finance $25,000 at 7% for 60 months. Monthly payment $495. Total paid $29,700. You're done in 5 years. Scenario B, finance $35,000 at 7% for 72 months. Monthly payment $598. Total paid $43,056. You're still paying 6 years later. For just $103 more per month, you upgraded to a $10,000 more expensive car. Except you didn't spend $10,000 more, you spent $13,356 more. Plus, you're making payments for an extra 12 months, an entire year of your life sending money to the bank every single month. And here's what happens in real life. Most people in scenario B will trade in that car at year 5 or 6, right around when they're finally close to paying it off. They'll still owe maybe $8,000 on it, the dealer will give them $6,000 for it, and boom, now they're rolling $2,000 of negative equity into their next loan. The cycle starts all over again, but worse. According to Experian data, the average amount financed for a new car in Q4 2023 was $40,366 at 7.1% over 68 months. That means the average American is paying $48,197 for their $40,366 car, almost $8,000 in interest alone. And most people do this every 6 to 7 years for their entire adult lives. Here's what most people don't realize, and this is where your jaw is going to hit the floor. It's not just about the interest you pay on the car loan. It's about the opportunity cost of that money. It's about what that money could have been doing for you instead. Let me compare two people, both 25 years old, both making the same income. Person A, the I deserve a nice car person, buys a new $35,000 car every 7 years, finances $32,000 at 7% for 72 months, monthly payment $547. This at age 25, 32, 39, 46, and 53. The I'll drive something modest person buys a $15,000 used car every 7 years, finances $12,000 at 7% for 48 months, monthly payment $287, invests the difference, $260 per month, in index funds averaging 10% annually, does this at age 25, 32, 39, 46, and 53. By age 60, Person A has spent $175,000 on cars and has a 7-year-old car worth maybe $12,000. Person B has spent $75,000 on cars and has a 7-year-old car worth maybe $5,000. So far, Person A spent $100,000 more on cars. That alone is significant. But here's where it gets absolutely wild. Person B also has $778,000 in their investment account. $778,000. The difference in car choice alone, just the car, created a $778,000 difference in net worth. And that's not even counting the higher insurance premiums Person A paid, the higher registration fees, the more expensive maintenance, the higher sales tax. All of that adds up to even more. This is what I mean when I say that a car loan might cost you hundreds of thousands of dollars over your lifetime. This is real math. This is what's actually happening. Now you're thinking, Rihan, come on, I can't show up to my job in some beat-up old car. I need to look professional. People judge you by what you drive. I worked hard for this. I deserve something nice. Look, I get it. I really do. This is where the psychology comes in, and this is why car loans are so devastating. We've been conditioned, programmed really, to see our car as an extension of our identity. It's a status symbol. It's how we signal to the world that we've made it, that we're successful, that we're responsible adults who have their lives together. And the car companies know this. The advertisers know this. That's why every car commercial shows attractive, successful-looking people living amazing lives, and their car is somehow central to that success. But here's the thing that's going to blow your mind. Wealthy people don't think like this. According to a study by Experian, 61% of people earning less than $50,000 per year have a car payment, but only 44% of people earning over $100,000 per year have one. Read that again. The people who can most afford a car payment are the least likely to have one. Why? Because wealthy people understand opportunity cost. They understand that tying up $500 or $600 a month in a depreciating asset is the opposite of building wealth. They'd rather put that money to work for them. I know a guy, actually knows him from college, who makes about $250,000 a year, drives a 2012 Honda Accord he bought used for $11,000, says it's the best financial decision he ever made because he invests the difference between what he could spend and what he does spend. Meanwhile, I see people making $45,000 a year driving $50,000 trucks with $800 monthly payments. Here's the psychological shift you need to make. Stop thinking about cars as investments, rewards, or status symbols. Your car is a tool. It gets you from point A to point B. That's the entire job description. Let me pull back the curtain on what's actually happening in that finance office, because once you see how this game works, you can't unsee it. The dealership makes money 3 different ways on your car loan. 1, the markup on the car itself. They bought it for less than they're selling it to you. This is obvious. This is expected. No problem with that. 2, the interest rate markup. Here's what most people don't know. When the finance manager tells you you're approved at 7%, that might not be the actual rate you qualified for. Banks give dealers a range. Maybe you actually qualified for 5.5%, but the dealer is legally allowed to mark it up to 7% and pocket the difference as commission. This is called dealer reserve, and it's completely legal in most states. On a $30,000 loan over 60 months, that 1.5% markup means the dealer makes an extra $1,200 in their pocket, and you pay an extra $2,400 in interest over the life of the loan, just for them marking up a number on a screen. 3, back-end products. Extended warranties, gap insurance, paint protection, fabric protection, tire and wheel coverage, prepaid maintenance, theft protection, VIN etching. They'll try to sell you all of this stuff, and some of it might make sense in very specific situations. But here's what you need to know. These products have insane profit margins. That $2,500 extended warranty, the dealer bought it from the warranty company for maybe $700. They're making $1,800 of pure profit on that one sale. And they're trained, like they literally go to multi-day training seminars on how to overcome your objections. They have scripts memorized. They practice these conversations until they can do them in their sleep. When you say, "I need to think about it," they don't say, "What's there to think about?" You're already approved. This is the fun part. When you say, "The payment seems high," they don't lower the price. They say, "Let me talk to my manager and see what I can do." Then they come back with a 72-month term instead of 60. Your payment drops, you feel like they worked hard for you, but you're actually paying thousands more. This is their job. They do this 8 hours a day, 5 days a week. You do this maybe once every 7 years. Who do you think is better at this negotiation? Okay, so we've established that traditional car financing is designed to extract maximum wealth from you. Now what? What are you actually supposed to do? Here are your real options, ranked from best to worst. Option 1, pay cash for used, the best option. Buy a reliable used car for $8,000 to $15,000 in cash. But Rihan, I don't have that kind of money just sitting around. I know, most people don't. Here's how you build it. If you currently have a $500 car payment, commit to keeping that car until it's paid off. Then, and this is the key, keep driving your paid-off car and put that $500 a month into a high-yield savings account. In 2 years, you'll have $12,000 plus interest. Sell your old car for whatever you can get, even if it's just $3,000, and now you have $15,000 to buy your next car in cash. Then you keep doing this forever. You keep paying yourself that $500 a month. In another 4 years, you've got another $24,000 saved. You can upgrade to a nicer used car if you want, or invest that money and keep driving what you have.
Option 2, finance used, keep it short, if you must finance. Here are the non-negotiable rules. Buy a 2 to 4 year old used car. Let someone else eat the worst depreciation. Put down at least 20%. Finance for no more than 48 months. Payment should be no more than 10% of your gross monthly income. If you can't meet all 4 criteria, you're buying too much car. A 3-year-old Honda Civic with 40,000 miles will easily run another 150,000 miles. You can buy one for $18,000 to $20,000, finance $15,000 at 6% for 48 months. Your payment is $352. That's manageable, and you're done in 4 years.
Option 3, finance new. Absolute last resort. If you absolutely must finance a new car, here's how to minimize the damage. Negotiate the price before discussing financing. Get pre-approved from a credit union first, they usually have better rates. Put down at least 20%. Finance maximum 48 months. Ask, is this the best rate I qualified for when they give you a rate? Say no to every single back-end product. Never trade in a car with negative equity. Plan to keep this car minimum 10 years. If you do go to a dealership, here's exactly what to say to flip the script. When they ask, what monthly payment are you looking for? You say, I'm not thinking in terms of monthly payments. I'm thinking in terms of total out-the-door price. What's your best price on this specific vehicle with a VIN number, whatever? When they come back with numbers, show me the full breakdown. MSRP, discount, dock fees, destination, accessories, everything. In the finance office, I already have financing secured at rate 0.5% lower than you expect. What rate can you beat? Even if you don't have pre-approval, say this. It completely changes the dynamic. When they offer a rate, is this the best rate I actually qualified for, or is dealer markup included? This one question can save you thousands. Just watch their face when you ask it. When they pitch warranties, email me the details and I'll review them at home with my spouse. They won't want to do this because they know once you leave and actually research it, you'll realize you don't need it. This isn't about cars. This is about how you think about money and wealth building. Every dollar in a car payment is a dollar not building your future, not invested, not growing, not working for you. The average American has a car payment for 35 to 40 years of their adult life. That's not normal. That's not just how it is. That's a choice the financial industry convinced us to make. If instead of a $500 car payment, you drove modest paid-off cars and invested that $500 monthly from age 25 to 65 at 10% average return, you'd have $3.16 million. That's the real cost of always having a car payment. I'm not saying drive a beater and be miserable. I'm saying understand the trade-offs. If you spend $50,000 on a car, you're choosing that over potentially $200,000 to Option 3, finance new. Absolute last resort. If you absolutely must finance a new car, here's how to minimize the damage. Negotiate the price before discussing financing. Get pre-approved from a credit union first, they usually have better rates. Put down at least 20%. Finance maximum 48 months. Ask, is this the best rate I qualified for when they give you a rate? Say no to every single back-end product. Never trade in a car with negative equity. Plan to keep this car minimum 10 years. If you do go to a dealership, here's exactly what to say to flip the script. When they ask, what monthly payment are you looking for? You say, I'm not thinking in terms of monthly payments. I'm thinking in terms of total out-the-door price. What's your best price on this specific vehicle with a VIN number, whatever? When they come back with numbers, show me the full breakdown. MSRP, discount, dock fees, destination, accessories, everything. In the finance office, I already have financing secured at rate 0.5% lower than you expect. What rate can you beat? Even if you don't have pre-approval, say this. It completely changes the dynamic. When they offer a rate, is this the best rate I actually qualified for, or is dealer markup included? This one question can save you thousands. Just watch their face when you ask it. When they pitch warranties, email me the details and I'll review them at home with my spouse. They won't want to do this because they know once you leave and actually research it, you'll realize you don't need it. This isn't about cars. This is about how you think about money and wealth building. Every dollar in a car payment is a dollar not building your future, not invested, not growing, not working for you. The average American has a car payment for 35 to 40 years of their adult life. That's not normal. That's not just how it is. That's a choice the financial industry convinced us to make. If instead of a $500 car payment, you drove modest paid-off cars and invested that $500 monthly from age 25 to 65 at 10% average return, you'd have $3.16 million. That's the real cost of always having a car payment. I'm not saying drive a beater and be miserable. I'm saying understand the trade-offs. If you spend $50,000 on a car, you're choosing that over potentially $200,000 to $300,000 more in retirement. Make that choice consciously. If you have a car loan, high interest, over 6%, check your credit score and refinance with a credit union. Underwater on the loan, stop trading in, make extra payments toward principal, keep it until paid off and beyond. About to buy? Save and pay cash if possible. If financing, credit union pre-approval, 20% down, 48 months maximum. If you paid off your car, keep paying yourself that amount into savings. Drive it until you can buy the next one cash. Resist the urge to reward yourself with a new car payment. Your car is not your success story, not your identity, not proof you've made it. Your car is a tool, just like you wouldn't buy a $500 hammer when a $50 hammer does the same job. Don't buy a $50,000 car when a $15,000 car gets you there just as reliably. The real flex isn't a luxury car with $800 payments. The real flex is no car payment and a growing investment portfolio. The real flex is being able to quit your job because you have 6 months saved. The real flex is retiring at 55 because you made smart decisions in your 20s, 30s, and 40s. Look, I know this might have been hard to hear if you're in a car you financed for 72 months. I'm not trying to make you feel bad. I'm trying to wake you up so you can make better decisions going forward. The car loan industry is counting on you not doing this math. They're counting on you thinking about monthly payments. But you're smarter than that. You watched this whole video. That tells me you're serious. Before you sign that next loan, come back and watch this again. Run the numbers. Think about what you're giving up. My guess is once you understand the real math, you're not signing that loan. You're going to save up, buy something modest, invest the difference, and years from now, you'll look back at this as the turning point, when you stopped thinking like a consumer and started thinking like a wealth builder. If this helped, smash that like button. Subscribe for more content on building real wealth. Comment on your car situation. Are you making different choices after this? I'll see you in the next one.